Welcome to This Explainer. Today we're tackling one of the most fiercely debated questions in personal finance. We're going to dive into a detailed 2-decade comparison to answer a seemingly simple question. Does real estate or the stock market actually build more wealth? If you've ever wondered exactly where to park your capital to secure your financial future, well, you're in the right place. We're going to break down the mechanics, the math, and honestly the psychological realities of both paths. And importantly, we're going to spend some time uncovering the hidden multipliers that make real estate such a uniquely powerful wealth-building engine.
So how do we actually figure this out? We're going to trace the 20-year journey of two fictional investors using completely different strategies. By tracking them over 2 full decades, we don't just get a static snapshot in time. We actually get to see how wealth is generated through the wild, unavoidable ups and downs of real-world economic cycles. One investor is betting their future on physical property, and the other is putting their trust in a broadly diversified stock market. Let's see how they actually hold up when life inevitably gets in the way.
Right. Let's jump into phase 1, making the initial investment.
Now we have to talk about leverage. This right here is the absolute secret weapon of real estate. It's exactly how you can control a massive $500,000 asset with, say, just a $100,000 down payment. Think about that for a second. If that property appreciates by a relatively modest 10%, you don't just make 10% on your money, you make a massive 50% return on your initial cash. This invisible multiplier effect is the core reason why bricks and mortar have created so many millionaires over the years.
But right out of the gate, you can see these strategies are fundamentally opposed. The real estate investor locks up a big chunk of their capital to control one giant asset using that leverage we just talked about. The stock market investor, they go the opposite route. They aim for high liquidity and broad diversification, injecting their cash into index funds across hundreds of companies. They completely avoid the opportunity cost of tying up all that capital in one massive down payment. It's two totally different philosophies on how money should work for you.
Moving on to phase 2, surviving the first decade, where theory turns into reality.
In these early years, the honeymoon phase ends pretty abruptly. The real estate investor is suddenly wrestling with some highly tangible real-world issues. They're managing mortgage payments, relying on steady cash flow, and then boom, they get hit with a 3 a.m. plumbing disaster or a blown water heater. It happens, right? Meanwhile, the stock investor isn't fixing any toilets, but they wrestle with a totally different beast, the psychological torment of market volatility. Their portfolio might literally drop 20% in a single month, which forces them to hold their nerve and rely on the absolute unyielding discipline of dollar-cost averaging.
And when the real world really hits in years 6 through 10, things get super turbulent. Economic slowdowns, inflation, shifting interest rates. We rarely get a smooth ride in investing. But notice how real estate acts as a unique shield here. This is huge for building wealth. As inflation spikes, rent generally goes up and property values rise. But, and here's the kicker, that 30-year fixed mortgage debt stays exactly the same. Inflation is literally eating away the property owner's debt for free. The stock investor, on the other hand, has to stomach massive market corrections and watch their net worth swing wildly based on global events entirely outside of their control.
So the crucial difference here really boils down to emotional and physical bandwidth. The property owner is practically running a part-time business. It's sweat equity. We're talking active, time-consuming tenant issues and physical repairs. The stock investor is physically passive, sure, but they need nerves of absolute steel, what I call emotional titanium, to not panic sell when the market suddenly drops. One path is hands-on and time-consuming. The other is mental and requires immense emotional discipline.
Fast forward to phase 3, 20 years later. Let's look at the actual results.
After 2 decades, the contrast is just incredible. The stock investor has successfully surfed the wave of compound interest, effortlessly multiplying their money while maintaining total flexibility. But the real estate investor, they've benefited from the ultimate wealth hack, amortization. For 20 straight years, other people, their tenants, have literally been paying off their massive debt for them. That builds undeniable home equity month after month. Combine that tenant paydown with property appreciation, that initial power of leverage, and significant tax write-offs through depreciation, it's easy to see why real estate becomes an absolute wealth powerhouse that stocks struggle to match in terms of tax efficiency.
But actually, let's pump the brakes for a second, because it's not all upside for the property owner. There is a massive risk concentration here. Over 80% of their net worth is anchored to one single physical location. That makes them completely vulnerable to hyper-local market crashes or natural disasters. Compare that to the stock investor, whose wealth is spread across hundreds of the world's most successful companies. So yes, real estate builds immense wealth, but you are concentrating your risk significantly to get those returns. Ultimately, both avenues successfully built substantial wealth over 20 years. But the exact final numbers, they depend entirely on execution. For the real estate investor, their massive wealth was built because they effectively managed their leverage and kept the property in good shape. For the stock investor, it was all about consistency, holding and buying during those nasty downturns without giving in to the urge to panic sell.
Okay, before we declare a definitive winner, let's jump into Section 4, Debunking Common Investing Myths.
Let's clear the air on a few things. First, real estate is rarely a fully passive endeavor. Even with a property manager, it requires active oversight. On the flip side, broadly diversified stocks are definitely not a casino. You're buying fractional ownership of real, profitable businesses. And the idea that all debt is bad, that's a huge myth. Strategic debt is exactly what fuels the real estate wealth engine when used as leverage. Finally, simple cash flow does not equate to actual profit, not once you factor in the hidden expenses, taxes, and surprise capital expenditures.
So, bringing it all together in Section 5, which strategy actually wins?
I know everyone wants a super simple asset A beats asset B answer, but the truth? There is no universal winner. It all comes down to aligning the underlying mechanics of the asset with the life you actually want to live. Ask yourself, do you want the active entrepreneurship of property management, or do you crave the truly hands-off, passive nature of index investing?
Let's break it down. If you have the time, the entrepreneurial drive, and the stomach to safely manage leverage, real estate's unique mechanics will absolutely accelerate your wealth rapidly. The combination of leverage, tenant-paid amortization, and those massive tax benefits makes it an almost unbeatable wealth-building engine. But if you value extreme flexibility, geographic freedom, and zero daily management, the stock market is unquestionably your best bet. You can literally build wealth while sitting on a beach, provided you don't panic when the market dips.
Regardless of the path you choose, our 20-year analysis reveals a few non-negotiable principles for success. You absolutely have to think in decades, not days. You must understand how leverage can either multiply your wealth or completely destroy it. You've got to remove emotion from your financial decisions, match your assets to the lifestyle you actually want, and above all, you can never, ever stop learning.
I'm going to leave you with this final, vital thought. Knowing what you know now about the incredible multiplier effect of real estate leverage, the actual time commitments required, and the totally stress-free but volatile nature of compound stock growth, which strategy truly fits the future you want to build? The choice is entirely yours, but the time to start building is now. Thanks for joining me for this explainer, and I really hope this clarity helps you confidently take your very next financial step.